Hello everyone, this is CA Rohit Grover and again welcome you all to the Lakshya Institute of Professional Studies, right? So up to so far we have done the company audit, we have done the CARO chapter, we have done the provisions relating to books of accounts, we have also done the dividend provisions, right? So section number 123 to section number 148 we are already done with. So let us start now with the other audits. Let us start with the other concepts of the audit now. So today, as you can see it on the screen, that today's topic is going to be audit of consolidated financial statement. So what is the name of the topic? Audit of consolidated financial statement. Now, before entering into this particular topic, let me give you one straight away a clarification that when it comes to this chapter, most of the students thinks that it's a very liberal chapter, it's a very simple chapter. Yes, it is simple chapter, it's a very easy chapter, but at the end of the day it is also a very hard and cemented fact that when it comes to the CA final examinations, at least one question has to come from the audit of consolidated financial statement, and sometimes it has been seen that more than one question also has come. I mean, I'm trying to say that two questions have also come from this particular chapter. So in any case, this chapter is going to give you 4 to 5 marks in the examination. So it is going to give you how many marks? Minimum 4 to 5 marks are definitely going to come from this chapter. So without wasting the time, let us first understand what do you mean by consolidated financial statement. Then we'll understand what do you mean by responsibilities of the management when it comes to the consolidated financial statement preparation. What is the auditor's responsibility when he is doing the audit of consolidated financial statement, and how do we audit the consolidation? What are the provisions relating to completeness of components, and the various 5 different options relating to auditors reporting responsibility when it comes to the audit of consolidated financial statements. So let us understand what you understand by the term called consolidated financial statements. Now see, what do you mean by consolidated financial statement? First of all, as we all know that section number 129 of our Companies Act 2013 decides the definition or gives us the definition of the word called financial statement, where we have understood that whenever the word called financial statement comes to our mind, there are 5 things comes to our mind. So what are the 5 things comes to our mind? Balance sheet, profit and loss statement, then cash flow statement, notes to accounts, and statement of changes in equity. The same 5 things when we talk about the consolidated financial statement, it's the same definition of consolidated financial statement is also provided under section number 123. Now what is the definition of consolidated financial statement under section number 123? Now when we talk about the consolidated financial statements, consolidated financial statement includes consolidated balance sheet, it includes consolidated profit and loss statement, it includes consolidated cash flow statement, and it also includes a consolidated statement of changes in equity. So as standalone financial statement definition is given under section number 123, 29, and same consolidated financial statement definition is also given under the same section. So this is basically the framework of this particular chapter called audit of consolidated financial statements, right? Now, very interesting topic, very small things are there, and there are so many clarifications which you need to have when we are doing the audit of consolidated financial statements. So say for example, how we are going to start with this particular chapter is like, suppose Reliance India Limited, and now Reliance India Limited is having say for example 40 to 50 subsidiaries, or 20 to 30 joint ventures, or 10 to 15 associates. So when you are an auditor, of consolidated financial statements, when you are an auditor of a consolidated financial statement, it means you are an auditor of the parent company, as well as you are an auditor of doing an audit of consolidation of the total group as well. You're going to do the audit of consolidated group as well. So that's the reason consolidated financial statement means what? When the definition of 129 comes to our mind about the financial statement, we just have to prefix the word called consolidated. So balance sheet became consolidated balance sheet, and profit and loss became consolidated profit and loss, consolidated cash flow statement, consolidated statement of changes in equity. Are you getting the point? Now here, what do you mean by consolidation here? Consolidation means this is that balance sheet, that P&L and that cash flow statement where all the components and the parent put together are representing their financial position via balance sheet, group financial results via P&L account, group cash flows via cash flow statement, and group changes in equity via statement of changes in equity. So this is what do you mean by consolidated financial statement. So basically, we all know that consolidation is the prime responsibility of the parent company. Consolidation is the prime responsibility of the parent company, and sometimes it is the responsibility of the subsidiary also, which is having further subsidiaries. Are you getting the point? That generally consolidation is the prime responsibility of the parent. So if there is a subsidiary which is having further subsidiaries, it means that subsidiary is also a parent of some company or not. So that is the reason consolidation is a prime responsibility of the prime responsibility of the parent company. So I hope every one of you understood what do you mean by consolidated financial statements, right? Now, along with the consolidated financial statement framework, now there is a very important thing we have to understand before entering into the chapter. Right now, what we are doing is called the introduction of the chapter, how we are going to read the chapter as a whole. Now, understand one thing, when we talk about the consolidation, there are two types of companies in India basically. What are the two types of companies? There are one set of companies which believes and which uses still the accounting standard based financial statements. It means there are companies in India who are still using accounting standard based financial statement, who are still preparing accounting standard based financial statement, and there are another set of companies in India which are using IND-AS standard based financial statements, or they are preparing IND-AS based financial statement. So there are two set of companies in India. Now remember one thing, one set of company which uses the which uses the accounting standards while preparing the financial statement, they are covered under division 1. And there are another set of companies which uses the IND-AS, Indian Accounting Standards, they are being covered under division number 2. But either it is division number 1 consolidation or it is division number 2 consolidation, both are covered under schedule 3 only. See, format of financial statements is given under schedule 3, that we all agree. Format of financial statement, like it should be tabular form or it should be in the not in the T form, now it is in the vertical form. All that format has been given under schedule number 3. Are you getting the point? Now under the schedule number 3, there are set of companies which are following IND-AS, there are set of companies which are following accounting standards. So those companies which are following the accounting standards, on them division 1 rules of consolidation are applicable, and those companies which are using the accounting standards, not in Indian accounting standards, so those who are using the Indian accounting standards for division 2, and those who are using the accounting standards for division 1. So what is the format for preparation of financial statement? For the division 1 companies are those companies which are using the accounting standards while preparing their financial statement, and division 2 companies are those companies which are using what? IND-AS. As you all know that IND-AS is nothing but the new phase of the accounting standards. So slowly accounting standards are getting phased. Standards are getting phased out of India, and IND-AS is taking over the accounting standards. Am I clear to everyone? Yes. So this is what the basically the introduction of the chapter. So before starting the chapter, what actually this chapter is going to make you understand, you should have the two clarification. There will be two set of companies which in your practice also you will come across if you are happening to be a consolidated auditor, consolidated financial statement auditor of a particular group. So you have to understand one fact, that when you will be appointed as an auditor for consolidated financial statements in your future, when you will be a practicing chartered accountant, you have to understand that whether that company is using accounting standards while preparing the financial statement, or they are using the IND-AS while preparing the financial statement. Accordingly, you have to take a call whether which kind of responsibilities and duties you have towards IND AS based financial statements and accounting standard based financial statement. And before that, we have already understood the meaning of the word called consolidated financial statement. So section number 129 talks about the financial statement. We have to prefix a word called consolidated before all those financial statement. It will become the definition of consolidated financial statement. So up to this point, I hope everything is crystal clear. Yes. So let's move ahead. Now, first of all, let me give you the introduction of section number 129 subsection 3 first of all. Now, what is section number 129 subsection 3 is saying that ki every parent company along with its standalone financial statements, every parent company along with its standalone financial statement shall also have a responsibility to prepare consolidated financial statements of all as a group as a whole. It means including all its what components. So when I'm using the word called components, there are three things should come to your mind. Components means subsidiaries, components means joint ventures, and components means associates. So if a Reliance India Limited, so let's take an example. If the Reliance India Limited is preparing its own financial statements, along with its own financial statement, Reliance India Limited also has to prepare consolidated financial statements of a group. Consolidated financial statements of a group. So group includes what? Group includes parent itself, group includes its components. Under the components, there are three types of components: subsidiaries, joint ventures, and associates. That is what is written under section number 129 subsection 3. So let us understand again what is section number 129 subsection 3 is talking about. So section number 129 subsection 3, it says that ki every parent company along with its standalone financial statements. Sir, let me tell you one thing. There are so many places where I'm going to use the word called standalone financial statement. To understand one thing, standalone financial statements are known as your own financial statement. So I'm talking about parent's own financial statement. So every parent company along with the preparation of its own financial statement shall also prepare the consolidated financial statements including all its components. So what is the parent's responsibility? Own financial statements as well as the consolidated financial statements of its all components, including all its components. And I already told you, when I talk about the word called components here, so components means subsidiary, components means joint venture, and components means associates. That is what is written in section number 129 subsection 3 in relation to responsibility of a parent company to prepare the consolidated financial statements. I hope I made it very clear that what section number 129 subsection 3 is talking about. Now, next section is section number 129 subsection 4. Section number 129 subsection 4 talks about what? Section number 129 subsection 4 says that ki whatever the provisions, whatever the rules, whatever the regulations, whatever the provisions, whatever the rules, and whatever the regulations which are applicable on preparation of standalone financial statements of a parent company are equally applicable to consolidated financial statements as well. It means section number 129, which is talking about the financial statement, section number 133, which is talking about the accounting standards, schedule 3 requirements, generally accepted accounting principles, accounting policies. So those rules and regulations which are applicable to your own financial statements are equally applicable to the consolidated financial statements. There is no difference in the accounting policies, no difference in the what do we say. So let us understand what 129 subsection 3 is saying, and again section number 129 subsection 4. So tell me everyone, repeat after me. What is section number 129 subsection 3 is saying? Section number 129 subsection 3 is saying that ki every company, every parent company which is preparing its standalone financial statement, along with its standalone financial statement, it also has to prepare the consolidated financial statements of its components. Components means associates, subsidiaries and joint ventures. And what is section number 129 subsection 4 is saying? It provides that the preparation, adoption and audit rules of stand-alone financial statements of a holding company are also applicable to consolidated financial statement. So whatever the rules, regulations, audit standards, everything which is applicable to the standalone financial statements of the holding company is also equally applicable to the consolidated financial statements. Now listen to this very carefully. This is a small amendment which came just now in section number 129 subsection 3. What I told you, parent company along with its standalone financial statements shall also have a responsibility to prepare the consolidated financial statements of its all components. Now I'm talking about the AGM of the parent company. I'm talking about the AGM of the parent company. Now what I'm talking about? I'm talking about the AGM of a parent company. Now what do you mean by AGM of the parent company? In the annual general meeting of a parent company. Listen to this very carefully. Still we are doing the introduction of this chapter only, because until unless our base of consolidation is not going to be strong, we will never be able to understand the chapter further. To understand, when the parent company's AGM is going on, parent company will get its own financial statements approved. Parent company will also lay down the consolidated financial statements, and now the third responsibility is that parent company shall also lay down the separate financial statements of its all components also in the same AGM. So it means in the AGM of the parent company, now three types of financial statements are going to be laid down. Standalone financial statements of the parent, standalone financial statements of all its components also in the parent's AGM, and consolidated financial statements of the total group. Now, sir, where it is being written? It has been recently provided by amending the Companies Act 2013. Earlier, what used to happen? Standalone financial statements of the components will be shown in their respective AGMs only. But now, standalone financial statements of the components also, subsidiaries, joint ventures and associates, that is also going to be laid down in the parents AGM. Why, sir? What is the reason? The reason is very simple, guys. Now, when we prepare the consolidated financial statement, now listen, let me give you one example. Say for example, there is one subsidiary 1, subsidiary 2, subsidiary 3. Now subsidiary 1 and parent. Now parent is having 4,000 crores of profits. Subsidiary 1 is having 2,000 crores of profit. Subsidiary 2 is having 1,500 crores of profit, but subsidiary 3 is having 2,500 crores of losses. Now 2,500 crores of losses are there. Can you imagine? Now tell me the consolidated P&L will be how much? 4 plus 2, 6 plus 15, 7,500. So it will be maximum 5,000 crores only. Now tell me, when I will show you only the consolidated profit in the AGM, how you will come to know that which subsidiary is a profit making and which subsidiary is a loss making? You will never come to know. Therefore, in the same AGM, the standalone financial statements of the parent are going to be displayed. The consolidated financial statements of group are going to be displayed, as well as the standalone financial statements of components are also going to be displayed in the same AGM. I hope every one of you understood or not, so that that person who is sitting in the AGM of the parent company should have a better idea whether particular subsidiary, particular joint venture or particular associate is a profit making associate, subsidiary, joint venture, or a loss making associate, subsidiary or joint venture. So this is what is written here. Now read it. In the AGM of the parent company, standalone financial statements of the parent plus consolidated financial statements of the group plus standalone financial statements of all its components are also required to be laid down in the AGM of parent company. That is also where it is written. It is also written in section number 129 subsection 4. I hope I made it very clear to everyone what I'm trying to tell. Yes sir. Now it is being provided that now parent company, that's what I explained you. Now I have written it as well so that you can understand how to write that particular thing in the examination. it is being provided that now parent company shall have to present standalone financial statements of its components also, that is subsidiaries, associates and joint ventures, in the same AGM and attach such financial statements in AOC1 format. What is the format? AOC1 format, along with its own financial statements. So when you are presenting, when you are sending the financial statements of your own, you also have to attach the standalone financial statements of your components also, subsidiaries also, joint ventures also and associates also, along with the financial statements of parent company. It is also required to be sent to the members. Now sir, where this responsibility written? It is written in section number 129 subsection 4. I hope I made it very crystal clear to you, right? Now next thing what we have to understand, is exemption from consolidation. But if I remember, this topic we have already covered while doing the section number 129. But as it is also a part of audit of consolidated financial statements chapter, so I'm going to tell you this point again here in this particular session. Now let us first understand what we have done so far. So sir, what we have understood? We are doing the chapter called audit of consolidated financial statement. What we have understood is the consolidated financial statements or consolidated financial statements audits framework. Point number one, we understood what do you mean by consolidated financial statement. It includes consolidated balance sheet, consolidated P&L, consolidated cash flow, consolidated statement of changes in equity. Next one, what are the formats? Like if the company is following IND-AS, then its consolidated financial statements are required to be prepared as per division number 2 of schedule 3. But if the company is following accounting standards while preparing financial statement, then its consolidated financial statements also is going to be prepared as per division 1 of schedule 3. So that also I made you understand. So section number 129 subsection 3 says what? Ki it is the responsibility of the parent company that along with its standalone financial statement, it also needs to prepare the financial statements of all financial statements of the group, including its components. Consolidated financial statements of the group, including its components, right or not? And section number 129 subsection 4 says that whatever the rules and regulations, preparation, disclosure criteria which are applicable to the standalone financial statements of parent company are equally applicable to the consolidated financial statements. And in the AGM of the parent company, what I told you just now, standalone financial statements of the parent will be laid down, and consolidated financial statements of the group will be laid down, and standalone financial statements of the total components also is going to be laid down. And company while sending its financial statement shall also attach the copy of financial statements of its components in the format of AOC1. I hope up to this point there is no problem at all. Yes sir, no problem. Okay, if there is any problem, you already know in the I have already provided you the contact number where you can contact me and send me your queries. I'll be very much glad to give the answers or solutions to your queries, right? Okay, so next point is what sir? Exemption from consolidation. Now I already told you this point under the books of accounts chapter, maintenance of books chapter, under section number 129. Now see, there can be two types of subsidiaries. First of all, let me give you the answer. Let me give you the idea of what we are going to talk about here. Now listen to this very carefully. Now see, I already told you this, but still I am explaining again. Generally the responsibility of preparation of consolidated financial statement is whose? It is parent's responsibility. Are you getting the point? Now suppose A is a holding of B and B is a holding of C. A is a holding of B and B is a holding of C. It means A is also parent company and B is also parent company. Now A is a parent company of B as well as C, whereas the B is the parent company of C. It means B also has to prepare the consolidated financial statements of B plus C. Are you getting the point? And P has to prepare the consolidated financial statements of A plus B plus C along with their respective standalone financial statement. Up to this point, everything is clear? Yes, sir. Now, if you remember in section number 129, I already told you कि if you are a intermediate, if you are a intermediate, I'm talking about the center. If you are a intermediate wholly owned subsidiary which is having a further subsidiaries, which is having what? Further subsidiaries. So being a parent, intermediary parent, being a intermediary parent. Now tell me in the whole transaction, who is an intermediary parent? B is an intermediary parent. Is it a parent of C or not? And is it in the center or not? So yes, if you are an intermediary parent, or if you are from this angle, you can say that if you are an intermediate wholly owned subsidiary, then in that case, what will happen? Your subsidiary, your consolidation exemption will be provided, and now you need not prepare the consolidated financial statement, because now the consolidated financial statement preparation is a prime responsibility of your immediate parent. If you remember, we have already discussed that point in section number 129. If you have not understood and not listened carefully, go back to section number 129 again and listen to that point again. Right or not? So if you are an intermediate wholly owned subsidiary, or if you are an intermediate parent company, then if your immediate parent company is located in India, then located in India and filing the registers and returns with the ROC on time, then you no more have to do the consolidation. Your parent will do the consolidation. Clear, everyone? So what I have done now is I have divided the same concept now into two parts. But let me tell you one thing, at that point of time, I told you that it is not only available to the intermediate wholly owned subsidiary. This exemption from consolidation is also available to the partially owned subsidiaries. So as on the board, you can see that there are two types of subsidiaries in case you are a wholly owned subsidiary, or in case you are a partly owned subsidiary. So in case you are a wholly owned subsidiary and in case you are a partly owned subsidiary, what are the conditions you have to satisfy so that you can get an exemption not to do consolidation for your components, because your consolidation will be the responsibility of your parent. So you will be exempted from doing the consolidation. Are you getting the point or not? So let me write an example here. A, B, C. So we are talking about B. We are talking about the B. B as a wholly owned subsidiary. What? When it will get the exemption from the consolidation, and B as a partially owned subsidiary when it will get an exemption. We have already discussed in 129. Again, we are discussing it here. Now let's understand without wasting the time. Now, condition number one. You will get the exemption. You will get the exemption under what? You will get the exemption for consolidation. Sir, when you will get the exemption? You will get the exemption from consolidation. Sir, when? Only when? Sir, when? Only when? So when you will get the exemption? So you will get the exemption only when neither you are a listed company or nor you are going for a listing of your securities. So neither you should be a listed company nor you are going for the listing of your securities either in India or outside India. Either you are a partially owned subsidiary or you are a wholly owned subsidiary. In both the cases, condition number one is satisfied, you will get an exemption from the consolidation. But remember, we don't only have to satisfy one condition, we have to satisfy all the condition. Among all the condition, what is the condition number one for both wholly owned subsidiary and partially owned subsidiary? So condition number one is, if you are a wholly owned subsidiary or if you are a partially owned subsidiary, you should neither be listed in India or outside India, or nor you are in the process of getting listed in India or outside India. Condition number one satisfied on both the cases, you will get an exemption. But still, there are two more conditions which you have to satisfy. So what is the second condition? The second condition is your immediate parent company. Now tell me, what is the immediate parent company of the B? Immediate parent company of the B is nothing but called what? A. Your immediate parent company must be located in India and filing with the ROC the various registers and returns and complying with the appropriate accounting standards. So your immediate parent company must be located in India, filing the registers and returns with the ROC and doing the compliance of accounting standards. Are you getting the point? This point is also equally applicable for both wholly owned subsidiary as well as for the partially owned subsidiary. That's why it is written same. That's why it is written same here. But If you are a wholly owned subsidiary, there are only two conditions required to be satisfied. But if you are a partially owned subsidiary, there is one additional condition you have to satisfy. Which conditional? Additional condition. So what is the condition number 3? Now listen to this very carefully. I am that partially owned subsidiary which is having further subsidiaries for which I have to do the consolidation. I need an exemption. What should I do? Condition number 1 I satisfied. I'm not a listed in India, outside India, nor I'm in the process of getting listed. Condition number 2 also I satisfied because my immediate parent company is located in India and doing the compliance of accounting standards. Now what is the condition number 3 I have to satisfy? Understand it very clearly. Now listen. I, as a subsidiary company, sent one written consent to the non-holding members. To the which members? Non-holding members. Sir, what do you mean by non-holding members? Non-holding members are those members which we call it as minority interest members, which are not non-holding interest is that interest in which the holding is not having an interest. Let me give you a very simple example. 70% holding you are. I'm a 70% subsidiary of my holding company. What do you mean by 70% subsidiary? In my company, 70% of the share capital is held by whom? My holding. But what about the 30%? That is held by the holding or that is non-holding? Non-holding. So listen to this one. If I'm a partially owned subsidiary, I have sent one written notice to the non-holding members. Do you have any objection if I do not prepare the consolidated financial statements and do not present it in the AGM? And if those members do not have that objection for non-preparation of consolidated financial statements by a partially owned subsidiary, I should have the evidence of that non-objection and evidence of sending the written notice with me. Then in that case, condition number 3 is also satisfied. Then I, as a partially owned subsidiary, is also exempted from consolidating the financial statements. Clear, everyone? So let us wrap it up in a very quick manner. Now, exemption from consolidation under Companies Act. This is a Companies Act exemption. Then again, we'll do one more exemption to the subsidiaries under the, what do you say, INDAS, and one exemption under the AS. Now listen to this very carefully. If I'm a wholly owned subsidiary, do I have to do the consolidation of my components? Answer is no, sir. When? If two conditions are satisfied. I'm talking about the wholly owned subsidiary. So condition number 1, neither I'm listed in India or outside India. Sir, condition number 2, sorry, neither I'm listed in India, outside India, or nor in the process of getting listed in India or outside India. So condition number 2, my immediate parent company is located in India. It is filing the registers and returns with the ROC in India, as well as it is doing the full compliance of accounting standards. So I'm an intermediate wholly owned subsidiary. I will get an exemption from consolidation. Now, I'm a partially owned subsidiary. When will I get the exemption? When all the three conditions will be satisfied. How many conditions? All the three conditions will be satisfied. Condition number 1, same listed wala condition. Condition number 2, same immediate parent companies in India, ROC and compliance of accounting standard wala question. And condition number 3, I have sent a written consent to the non-holding members taking their non-objection. If they do not have any objection, if I do not present them the consolidated financial statements, if they do not have any objection and I have an evidence that I have sent a written notice to them for that concern, then in that case I will get an exemption. I hope everyone is crystal clear. This we have already done, but still we spent 5 to 10 minutes to make you understand again. So that brings an end to our next topic called exemption from consolidation. Clear, everyone? Yes, sir. Clear. Now, that is what a partially owned subsidiary can do, or that is what the wholly owned subsidiary do. But in case central government suo moto wants, in case central government suo moto wants, or on the application made by any kind of company, central government may grant that exemption also. It means central government has a power to grant the exemption from consolidation either suo moto or on an application made by the company to get that exemption. Clear, everybody? So I hope up to this point there is no requirement of any clarification. We did it very super fine, right or not? Next thing, we are still in the introduction part. We have not yet started how to do the audit of consolidated financial statement because base is required to be created, right? Now, point number 1, there are some definitions which you have to understand. actually there is no difference of the definitions when it comes to the definitions as per accounting standards and definitions as per IND-AS. But let me tell you one thing. There are some changes in writing. Intention is same. Meaning is same. Whether you follow AS or you follow IND-AS, meaning will remain same. Only the writing will change. Now, what is the first definition we have to do? We have to do the definition of what? Associate. What is the first definition? Definition of associate. So, if you'll see the definition of associate under the accounting standard, what do you mean by associate? An associate is the one in which the another company is having a significant influence. Sir, what do you mean by significant influence? At least 20% participation in voting rights and business policies. Either you have a 20% participation in the voting rights of the company, or you have a 20% participation in the business decision making and business policies of the company. It means that company in which you have that 20% of participation either in voting rights or business policy decision, that company is known as your associate. Now the same meaning of the associate is given under what? IND-AS. So if you are doing the definition of associate under IND-AS, then also it is same definition, so no change. What is the second definition? I'm just doing it for the formality because we already know, right or not? And one more thing, associate is neither a subsidiary or joint venture. Joint venture means where the two companies are having a joint contractual control as per their contractual agreement, right or not? And subsidiary is where the more than 50% of the voting rights are there. So you can indirectly say that 20% to 50% of the control if you have over the another company, that another company is yours associate, either it is under AS or it is under IND-AS. I hope I'm crystal clear to everyone. This is what do you mean by associates. Clear everyone? This is what do you mean by associates. Next. Sir, what is the meaning of the control? What is the meaning of the control? Now see, there I have written both the sides separate thing. But if you will read both the things, intention will remain same. Only the writing difference is there. Now what is the first one? Either directly or indirectly over more than 50% of the voting rights. It means we are talking about the control in context to subsidiary now. In context to subsidiary. So in the subsidiary, if you have directly or indirectly more than 50% of the voting rights in the subsidiary company, that is called your control. And control, or if the voting rights control criteria is not met, or if you are able to control over more than 50% of what? Composition of the management of the company, then also that company is called your subsidiary. I hope we all have done that in our intermediate level while doing the definition of the company secretary. Everyone is clear? Everyone is clear up to this point? Yes, sir. Okay. Now, same definition of the control is given under IND-AS. Same definition of the control is given under IND-AS, but in a different manner. Sir, how? When an investor, means what? Holding company, has rights over the investee, means what? Subsidiary company, and has ability to affect the returns through its power over an investee. Indirectly, they are not saying more than 50%. They are using the word called investor, investee, but intention of saying the word called control here or the word called control here. Here it is AS and here it is IND-AS. The answer will remain same. There no investor investee word has been used, as IND-AS are in comparison with IFRS International Accounting Standard. That's why little bit to enhance the standard of accounting standards of Indian accounting standards, they have used or copied the same things to incorporate in our portion. Are you getting the point? Now, joint control means what, or what do you mean by joint venture? A venture where the two or more parties will have the control over the economic activity as per the contractual agreement. So Reliance India Limited and Infosys went into the joint venture. So Reliance India Limited and Infosys, as per their contractual agreement, will have the joint control over the particular venture. Now this is the same having a meaning under the IND-AS. So in the IND-AS and in the AS, almost everything is same, just that when we talk about the control definition, instead of more than 50% of the voting rights or directly or indirectly more than 50% of the composition of management, they have written that investor has a right over the investee and has ability to affect the returns through its power over an investee. That's the only thing you have to remember when it comes to the definition of control as per IND-AS. Sir, why we are doing AS, IND-AS in the audit of consolidated financial statement? Let me give you a very clear idea, sir. You should know You should know both the types of consolidation as per INDAS, as per AS. Even though our effort will be little bit more, but at the end of the day you will be thankful to me saying that sir, yes, now we know how to do the audit of consolidated financial statements for those companies following accounting standards and for those companies following the INDAS. Right, sir, everyone? Okay. Now, there's nothing extra I'm going to tell you. Everything I'm going to tell you which is required for the purpose of examination. Deep questions, sometimes when they ask in the examination, you fail to answer it. So where the deep questions will come? Deep questions will come from these areas only, which we think that they are very much irrelevant for the purpose of examination, but they turn out to be the most relevant questions for your examination purpose. Clear, everyone? Chalo, let's do the next point. Next thing, the major difference between the AS based companies and IND-AS based company is one more major difference, that is called, in AS based companies we called non-holding members as minority interest. Suppose a holding company is having 70% of the voting rights in a subsidiary. It means remaining 30%, if the company are following the accounting standards, those 30% in our law language they are called as minority interest. But when it comes to the IND-AS, minority interest is not called minority interest, it is called non-controlling interest. It is called which interest? Non-controlling interest. That is the only difference. Meaning is same, only the way of saying it or way of presenting it or way of writing is different. Here it is called minority interest and there it is called non-controlling interest. Sir, where minority interest? In the accounting standard based audit. And in the IND-AS based audit, it is called as non-controlling interest. Means what? Holding is not having any control over those 30%. That is why it is called non-controlling interest. Now, what is the definition? A part of net results and net assets which are attributable to such interest which is neither owned or controlled by a parent. Are you getting the point? That part of the subsidiary, that shareholders or that paid up share capital or that interest of the subsidiary which is neither owned, controlled by the holding, their net assets and net results part is known as minority interest. That you same have a definition of minority interest and non-controlling interest when you reach to your FR paper, financial reporting. Now, what do you mean by non-controlling interest? Same point. Equity in subsidiary. What do you mean by equity? Equity means what? Net assets and net profits. Net assets, net profits attributable to minority interest. Right or not? The equity in the subsidiary not attributable to its parent is known as what? Non-controlling interest. So what is not attributable? What do you mean by attributable? What is not a part of a parent? What is not a part of a parent is known as what? Non-controlling interest. So here it is written part of net profits and net assets, and here it is written instead of net profits and net assets, it is written the word called equity. So I would like to just make you understand the difference between the definitions under the INDAS and definitions under the what do you say, this thing, AS. Are you getting the point? The first difference where we found is in the control. There we directly use the more than 50% of voting right or more than 50% of the composition management, and in the IND-AS we used it as investor-investee relationship. And second thing, here we call it as a net asset or net profits attributable to the non-minority interest, and here we called it equity which is not attributable to the parent company. Right, everyone? Next one. What do you mean by subsidiary? An entity which is controlled by a parent, and it is same. Now you can say that our introduction of the chapter is over. Now you can say the introduction of the chapter is over. Almost 40-45 minutes we have taken to just understand what this chapter is all about. So this chapter is all about consolidated financial statements audit. But before entering into this chapter, you should know what are the basic things you need to understand before, creating a building over a land. We just have to make sure that our foundation is very strong. So this is what the foundation related topics we have done. Now, the major questions which comes in the examination relating to audit of consolidated financial statement, one of the major important question which comes in the examination repeatedly and has been so many times asked is the responsibility of the parent company in the audit of consolidated financial statement. What are the responsibilities of the holding company or a parent company when the audit of consolidated financial statement is going on? That we have to understand. In total, there are total 6 responsibilities of the parent company. How many? 6 responsibilities of the parent company. So you can see that what is written here: preparation and presentation of consolidated financial statement is the prime responsibility of which company? Parent company. Sir, where we have understood section number 129 subsection 3, the very first topic. Section number 129 subsection 3 says that parent has to make its own financial statement, as well as it is also primarily responsible for the consolidated financial statements of its components. Other than that, that is a major responsibility that we already know. Other than that, what are the other 6 responsibilities? So basically you can say that there are total 7 responsibilities. How many responsibilities? So 7. First one we already know. Prime responsibility of the parent is to prepare the consolidated financial statements as a group, as a whole, including its component. That we already know. We have already covered in 129 subsection 3. Now, what are the other 6 responsibilities of the parent which you have to learn for the purpose of examination? That we have to understand here, right? Everyone, chalo, let us start. So out of 7 responsibilities, one responsibility we already know, which is the most primary responsibility. What? Responsibility for preparation of consolidated financial statement. Now there is a time we have to understand the 6 other responsibilities also. But we have to understand the 6 other responsibilities. Remember one thing, one by one. These are highly important questions which we are going to talk now. These are the major questions which are going to be the part of your examination now. Now let us start with the first responsibility of the parent other than primary. Now what is the first responsibility? Listen to this very carefully. It is the responsibility of a parent company to identify its components, and include their financial information in a consolidated financial statements. So it means, who is your subsidiary, who is your joint venture, who is your associate? That is not their responsibility to tell to the parent. It is the parent's responsibility to identify. It is the parent's responsibility to identify its components. Who is my subsidiary, who is my associate, and who is my joint venture? And it is also the parent's responsibility to include their financial information in consolidated financial statements. So sir, first responsibility mein what we understood that it is the parent's prime responsibility to identify its components and including the financial information of those components in the consolidated financial statement. Clear everyone? Yes sir. Now sir, what is the second duty? The second duty is, it is the parent's responsibility to identify its segments for the segment reporting purpose. Are you getting the point or no? It is the parent's responsibility to identify its segments for the segment reporting purpose. Means what? What do you mean by segments? As per AS 17, segments can be of two types. It can be business segments or it can be geographical segments. So it is a parent's responsibility to identify its reportable segments for the segment reporting purpose. Are you getting the point? So point number 1, it is a parent's responsibility to identify its components and include the financial information of its components in the consolidated financial statement. So point number 2, it is a parent's responsibility to identify its reportable segments. Point number 3, it is the parent's responsibility to identify its related parties and the related party transactions entered with them, if any. So related party, section number 188. So it is not the auditor's responsibility, it is the parent's management's responsibility to ensure that they have identified their related parties, and as well as they have also identified those related party transactions which have been entered with them. As you all know that we have to disclose it in our auditor's report. We have to make an opinion on this particular topic also in our auditor's report. So out of the total 7, here it is 6, but one we already know. Out of total 7, the 4 responsibilities we already know. So point number 1, it is the parent's responsibility to prepare the consolidated financial statements. It is a parent's responsibility to identify its components and include their financial information in the consolidated financial statement. It is a parent's responsibility to identify its reportable components and reportable segments, and it is a parent's responsibility to identify its related parties and related party transactions, if any. And it is a parent's responsibility to acquire and obtain the accurate and complete financial information of its components. Now tell me, do we have to include the financial information of the components in the consolidated financial statement or not? Yes. So it is whose responsibility that the information which is included in the consolidated financial statement is accurate and complete? Again, it is parent's responsibility. So you can say that this point is little bit connected with the point number 1. Are you getting the point? So it is a parent's responsibility to obtain the accurate, correct, and full information, complete information of the financial information of all its components, because they are directly going to be included in what? Consolidated financial statement. 5 responsibilities are over, 1 is hidden and 4 are written in front of you. And it is a parent's responsibility to do the consolidation adjustments. Sir, what do you mean by consolidation adjustment? Sir, consolidation adjustments means elimination of intra indebtedness, intra balances, and intra transactions. Are you getting the point? Say for example, I have given a loan to one of the subsidiary, or I have taken an advance from one of the subsidiary. So I have taken an advance, I have given an advance, so it is intra transaction, so they are going to be eliminated when we do the consolidation. I think more elaborately you will have an understanding in FR, but here also we have a very good topic on consolidation adjustments. Are you getting the point? So consolidation adjustments are of two types. One are known as permanent consolidation adjustments and one are known as current consolidation adjustments. Correct, everyone? So what do you mean by permanent consolidation adjustments? What do you mean by current consolidation adjustments? That we'll understand little bit below when we'll go and after doing these preliminary topics. So out of 7 responsibilities, 5 we already know, which are given there, and 1 we already know, which we have done in section number 129, subsection 3. So tell me the 5 now. Point number 1, identify its components and including the financial information of the components in CFS. Second one, identifying its reportable segments. Third one, identifying its related parties and related party transactions. Sir, fourth one, identifying the or obtaining the accurate and complete financial information of its components to be included in CFS, and most importantly, to carry out the consolidation adjustment, which are of two types, permanent and current. Sir, what do you mean by permanent? What do you mean by current? That you will understand later on. And what is the last one? Now listen to this, very simple, carefully. Sometimes what happens, the subsidiaries accounting policies are different and holding companies accounting policies are different. Suppose holding company is following SLM method of depreciation, subsidiary company is following WDV method, written down value method. Now when we'll do the consolidation, what will happen? It will create a problem to consolidate the SLM method with the WDV method. So what we'll do? We will do the harmonization. We will do what? Harmonization of accounting policies. Sir, what do you mean by harmonization of accounting policies? It is required to be done only when holdings and subsidiaries accounting policies are not same, they are different. And sometimes what happens, the gap followed by the subsidiary and the gap followed by the holding company are also different. So that is called conversion of the components gap as per the parents gap. Remember one thing, parents gap will not be converted as per the components gap. Component has to convert their gap as per the parents gap. Suppose components is in US subsidiary is there, so that is using US gap, but holding is in India, it is using Indian gap. So US gap related financial statements will be converted into India gap related financial statements. Are you getting the point or not? So that is called harmonization of accounting policies and conversions of gap. That is also whose responsibility? Parents' responsibility. Whose responsibility? Parent. So you can say that it is father's responsibility in connection with all its children. Children are of 3 types: subsidiary, joint venture, and associate. So tell me all the 7 responsibility. Now quickly, what is the 7 responsibility? Now close your eyes and start repeating after me. Point number 1. Primary responsibility of preparing the consolidated financial statement is also the responsibility of the parent company. Parent is also responsible to identify its components and including the financial information in consolidated financial statement. Point number 3. Parent is also responsibility to identify its reportable segments. Parent is also responsible to identify its related party and related party transaction. Parent is also responsible to obtain the accurate and complete information relating to its components to be included in CFS. Parent is also responsible to do the consolidation adjustments, and parent is also responsible for the conversion of gap and harmonization of accounting policies. I hope I made it very crystal clear about the very promising question which comes in the examination, which is known as parents' responsibilities in relation to consolidated financial statements. I hope everyone is crystal clear. Yes, sir, we are clear. Now, next one is known as auditors' responsibilities. Now, when we talk about the auditors' responsibilities, it goes to another level. Now, auditors' responsibility topic is quite bigger. Parents' responsibilities, while understanding in this chapter, were quite very smaller as compared to the auditor's responsibility, because auditor's responsibilities are divided into so many things. To give you the idea, what are the auditor's responsibilities? First of all, we'll understand what are the auditor's objective. That is point number 8. Then we'll understand what are his responsibilities in connection with the standards which he has to follow in relation to consolidation of financial statement. That is point number B, relating to standards on auditing, guidance notes and statements. Then point number C, we'll understand here. Now point number C, we'll understand his responsibilities relating to other financial information, right or not? And this is what the total 3 points we have to remember here. Total how many points we have to remember here? 3 points. So point A is relating to objectives, point B is relating to standards on auditing, guidance notes and statements, and point C is relating to other financial information related responsibilities. So there are total 3 areas where we have divided whose responsibilities? Auditor's responsibility. One by one we'll absorb the whole topic, and then we can be certain that if any kind of question relating to management responsibility, any kind of question relating to auditor's responsibility will come in your examination, you will be in a position to justify the answer. Shall we start? Okay, so let us start. What are the auditor's objective first of all when it comes to the audit of financial statement? Auditor's objectives are very simple. What are the auditor's objective? He has to first see that financial statements are prepared as per the applicable financial reporting statements. He has to first see that consolidated financial statements have been prepared as per AFRF. Sir, what is AFRF? Applicable Financial Reporting Framework. What do you mean by applicable financial reporting framework? Schedule 3 requirements are followed, accounting standards are followed, laws and regulations are followed. Each and everything which a standalone company has to follow, the same things are being followed and equally applicable to the consolidated financial statement that we have already read under section number 129 subsection 4. Clear, everybody? So what is the first objective? To see that financial statements are prepared as per the applicable financial reporting framework. Second thing, now does he have to give a guarantee on the financial statements, consolidated one? No, here also he has to express an opinion only. So second objective of an auditor is to express an opinion on the truthness and fairness of consolidated financial statements. So what a normal auditor does in case of component audit, the same responsibilities of the auditor are there in case of what? Consolidated financial statement. So out of the 4 objectives, 2 objectives are over. Sir, objective number 1, to see that the financial statements are prepared as per the applicable financial reporting framework. Sir, what is objective number 2? To express an opinion on the truthness and fairness of what? Consolidated financial statements. Sir, objective number 3. Now we have to go back to our audit chapter, company auditment. Do you remember section number 143 subsection 1? Duty to inquire 6 areas. Loans and advances granted must be secured. Personal expenses shall not be charged to P&L account. Bogus sales and purchase. Being a non-investment company, you are not allowed to sold your investment below your cost. Deposits shall not be, loans and advances shall not be categorized as deposits. So third objective, he has to ensure that all the duty to inquire under section 143 subsection 1 have been inquired or not. Clear, everyone? So out of three duties, three objectives, first one AFRF, second one truthness and fairness opinion, and the third one section number 143 subsection 1 duty to inquire. And the third thing, he also has to report on the matters under section 143 subsection 3, that is called other statutory and legal requirements para. Are you getting the point or not? If you remember, so many points were there. Books of accounts are prepared as per section number 128. Financial statements are in agreement with the books of accounts. Internal financial control systems are adequately placed and installed. None of the director is disqualified. Companies following accounting standards. Branch audit reports also have been received. Right or not? Company has not defaulted in transferring the money to the investors education protection, but so many points we have listed in 143 subsection 3, which we have done under the company audit. Are you getting the point or not? So what are the four objectives of an auditor? Sir, first objective of an auditor is to see that financial statements are consolidated, financial statements are as per AFRF. Second objective is to express an opinion on the truthness and fairness of the consolidated financial statement. So what is the third objective? The third objective is to ensure that duty to inquire under section 143 subsection 1 is being taken care of. And the fourth one, duty to report on certain other matters under section 143 subsection 3. So with that, our first part of auditor's responsibility is over. Now, what are the auditor's responsibilities when it comes to standards on auditing and guidance notes? Remember one thing, when we are doing an audit of consolidated financial statement and when we are doing a standalone financial statement audit, it is one of the same thing only. In the normal audit, do we plan our audit or not? In a normal audit, do we plan our audit or not? We plan our audit being in our office, that what kind of procedures I'm going to follow, what kind of evidences I'm going to collect, what are the techniques I'm going to adopt, acquiring the knowledge of client's business. All these are nothing but the part and parcel of planning or not. So in the consolidated financial statement also, SA 300 will take place. In the consolidated financial statement also, which standard will take place? SA 300 you have to consider as an auditor. So you here also have to plan your audit work of consolidated financial statement to carry out the CFS audit in a team manner. So in a team manner, what? Now, do we have to complete the audit on time basis? Yes, timely basis. Do we have to complete the audit on effectiveness basis? Yes, effectiveness. Do we have to do our audit in efficiency basis? Yes, efficiency. So T stands for timely basis, effectiveness basis, and efficiency basis. This is what do you mean by T. Clear, everyone? Yes, sir. Clear, everyone. So what is the first responsibility of an auditor in relation to standards when it comes to the audit of consolidated financial statement? First of all, he has to fulfill his four objectives that we are done in point number A. In the point number B, we are talking about standards on auditing, guidance notes, and other related statements. First standard what we have understood is he has to consider SA 300. He has to plan his audit in such a manner so that he can do his CFS audit on timely basis, efficiently and effectively. Clear, everyone? So SA 300 is the first thing what the auditor has to take care of. Right? Now, second thing, internal control system and accounting system. As an auditor, we always have to obtain the better understanding of internal control system, accounting system, and IT controls systems of an entity so that I can plan my audit procedures accordingly. If I do not have the knowledge of their internal control system, if I do not have the knowledge of the, what do you say, accounting system, if I do not have the knowledge of IT control system, then in that case, it is very difficult for me to plan my nature, time, and extent of audit procedures. So second thing is you need to obtain better understanding of the internal control system, accounting system, IT system of an entity to plan his nature, time, and extent. What is NTE? Nature, time, and extent of his what? Audit procedures. Do I have to follow compliance procedure here or do I have to follow substantive procedures here? Compliance means a little bit lenient in nature. Substantive means where you have to do the examination in depth. Clear, everyone? So on the basis of the internal control systems, accounting systems, and IT systems, I will plan my audit procedures also. So you can say that these 2 points are interconnected with each other. So I have to plan my audit in such a way so that I can conduct my CFS audit in an effective manner, timely manner, and efficient manner, point number one. And I have to obtain a better understanding of their internal control system, accounting system, and IT system so that I can plan my nature, time, and extent of audit procedure. Clear, everyone? Yes, sir. Clear. Now, what is the third thing? What is the third thing? Now, auditor has to ensure that he should apply his professional judgment. So, what kind of professional judgment is required? He has to apply his professional judgment in assessing the audit risks involved in the audit of consolidated financial statement. So, can I say that indirectly? Can I say that indirectly? We are talking about SA 315 here. Yes, assessment of the audit risk. Now, when you do the audit of a standalone company, do you assess the audit risk of that standalone company or not? Yes. In the same way, you have to assess the audit risk of what? In the same way, you have to assess the audit risk of consolidated financial statements also. What kind of audit risks can be there in the consolidated financial statement? Accordingly, you will develop your RAP. Sir, what is RAP? You will develop your RAP. Sir, what do you mean by RAP? RAP stands for Risk Assessment Procedures, so that you can bring down those risks to the lowest acceptable level. Are you getting the point or not? First, I will identify the risk. I will identify the risk. After that, I will assess the risk of the audit of consolidated financial statements. Then I will decide my RAP. I will plan my RAP. RAP stands for Risk Assessment Procedures. And accordingly, I will try to reduce the risks to the lowest acceptable level, because we all know that risk is something which cannot be eliminated, but it can be reduced with a good understanding of the risk profile of the company. So tell me, point number one, what is the standard number one we understood? So standard number one we understood, we have to take care of the SA 300, that is called audit planning. We have to have a better understanding of the internal control system, accounting system, and IT system, so that I can plan my NTE of audit procedures. That is also the auditor's responsibility. Auditor's responsibility is also to assess the risks in the audit of consolidated financial statement and plan his risk assessment procedures in such a way so that he can reduce those risks to the lowest acceptable level. Clear, everyone? Next one. What is the next one? To ensure that consolidated financial statements are being prepared as per standalone financial statements of a parent and its components complying the same AFRF. I already told you in the section number 129 subsection 4, this point already it is repeated here. Ki whatever the rules and regulations, what are the financial reporting framework which are applicable to the standalone financial statements are equally applicable to whom? Audit of consolidated financial statement. So jaldi let's wrap up this standard part, and after that we'll combine the audit objectives and the standard part, and we'll understand the full revision of the auditor's responsibility. Highly important topic. Highly important topic. Next one. He also has to ensure to understand whether he is in the need of the other auditor's work or not. Now let me give you one very idea. Now suppose the holding company auditor is Mr. A, the subsidiary company auditor is Mr. B. Now, are they the same auditors? No, A is different auditor, B is a different auditor. Both will be having the different professional judgments. If the auditor of the parent company thinks that he can do the audit on his own, he can do the audit on his own. He does not need to use the work of another auditor, means subsidiary auditor or joint venture auditor or the associate auditor. Then in that case, he will not make the use of SA 600. Sir, what is 600? Using the work of another auditor. So SA 600 comes into the place only when the parent auditor is not the auditor of components and he is thinking of using the work of auditors of the component company, which are different. But if the parent auditor, Mr. A, who is the auditor of the parent, thinks that he can do everything on his own, he does not require the need of the component auditors, then no SA 600. But if he thinks that he cannot do the audit on his own, he has to use the work performed by another auditor, then he has to take care of SA 600. So this point and this point are very much connected. Other auditors work. Now see, to ensure if the need arises, The consolidated financial statement auditor may use the work of another auditor in case he's not the same auditor of the other components. Obviously, if he is the same auditor of the parent and A is also the auditor of components, then there is no 600 existence at all. 600 will come when, sir? 600 will come when the parent auditor and the component auditors are different, and the parent auditor thinks that he cannot do the total consolidated financial statement audit on his own, and he has to ensure that he is using the work performed by component auditors. In that case, SA 600 will come, that is written below. So if the parent auditor or principal auditor is of opinion that he can't do it on his own, he cannot do the audit on his own, he has to comply with the SA 600. But if he thinks that he can do the audit on his own, he may do the CFS audit alone, no need to comply with SA 600. Very, very simple. So what are the standards we are done with? Sir, SA 300, planning, understanding of the internal control system, accounting system, IT system, so that I can plan my NTE of audit procedures. 2 point. Point number 3, I have to also understand, I have to apply SA 315. That is, I also have to identify the risk, assess the risk, and develop my risk assessment procedures, and to reduce the risk to the lowest acceptable level. Correct. And I also have to ensure that yes, the applicable FRF, which is applicable to the standalone financial statement, is equally applicable to the consolidated financial statement. I also have to ensure that if I am a parent auditor and the component auditor is different, then in that case, if the need arises, I may have a requirement of using the work performed by component auditor. Then if I think that I can't do the audit on my own, I need the help of the another auditor, SA 600 will come into the picture. But if I think that I am not in need of any 600 auditor, and I'm not in need of any another auditor, then SA 600 will not come into the picture. Clear everyone up to this point? Yes. Then we also have to consider SA 580. Sir, anybody can tell me what is SA 580? SA 580 stands for Written Representation Letter, which is also known as Management Representation Letter. Now, tell me one thing. Preparation of financial statement is the responsibility of whom? Sir, it is the responsibility of the parent. Okay. Doing the consolidation adjustment is the responsibility of whom? Parent. Identifying its component is the responsibility of whom? Parent. Reportable segments? Parent. Related party transactions? Parent. Including the financial information in CFS? Parent. Correcting the accurate and complete information? Parent. Consolidation adjustments? Parent. So everything is the responsibility of the parent when it comes to the financial statements which are consolidated in nature or not? Yes, sir. Now, don't you think that auditor needs an evidence in relation to the fact that parents have prepared the consolidated financial statements as per applicable FRF? Yes, for that, auditor needs to obtain WRL or MRL from the parents management or parents those charged with governance, stating that what are the 3 declaration he wants? Sir, parent has taken care of preparing the consolidated financial statements as per applicable financial reporting framework. Clear everybody? Yes. And they approve that consolidated financial statements are prepared by them, and they take the full responsibility of its preparation. 100% responsibility of the preparation of consolidated financial statement, and they have prepared the 100% financial statement as per applicable financial reporting framework. And they considered all the matters which are material for CFS preparation. Those important financial informations of the components which are material to be included, or some which are immaterial to not to be included, everything has been taken up as a responsible management. By whom? By the parents management. So basically SA 580 says that the auditor needs one evidence in his pocket saying that parents management is declaring 3 things. We have prepared the consolidated financial statements as per AFRF. Second one. So what is the second one? Second one is you can say that yes, while preparing the financial statement, all the important elements or material elements have been taken care of. And third one, that they take up the 100% responsibility of preparation of financial statement. So these are the three declarations the auditor of CFS must obtain from the parent company in relation to consolidated financial statement. So standard number SA 300, then obtain understanding of internal control system, then SA 315, then same standalone FRF is applicable to consolidated FRF, then SA 600 and whether the parent company and component auditor is same or not, and then SA 580. I hope everyone is able to understand that these are the auditor's responsibilities in connection with the audit of consolidated financial statement. And very highly important question, which if I will be the examiner, I would definitely and true 100% would like to test you on this part. Sir, why? What is there in this part? In this part, SA 320 is being talked about, audit materiality. So what is so big deal in that SA 320? Sir, when you will understand this topic now, you will fall in love with this topic. Sir, how? Now see. When we prepare the standalone financial statements, think logically. When we prepare the standalone financial statements, whether an auditor considers the materiality concept or not. Yes. Sir, what do you mean by materiality? Any item of the financial statement which may influence the decision making of the users of financial statement, that item is material to be included in the financial statement. As per SA 320, this is the definition of audit materiality. Sir, yes, we know. Materiality can be of two types. It can be quantitative materiality, it can be qualitative materiality. Sir, that also we know. That is what SA 320 says about. Sir, everything what you are saying is correct, but why you are saying is that is highly important. Now listen to this thing. When the consolidation of financial statements will take place, listen to this very carefully. When the consolidation of financial statements will take place, auditor has to apply the materiality concept in the consolidated financial statements also. Sir, yes, we know. Yes, that's a very general point. That is what is written in the first 2 points. That is what I have explained so far is written. Now see, while doing the CFS audit, materiality shall be considered separately for all components. Every component auditor has established the concept of materiality on their own while doing the audit of the components or not. Yes. But while doing the CFS audit, or while doing the CFS audit, following up the consideration. Now listen very carefully. You have to compute separately a materiality for the group as a whole. What is the responsibility number one? Auditor has to separately compute the materiality as a whole for the group. Sir, please throw some light on this particular point. Now, auditor in the CFS also has to apply a materiality concept, which components and which information is a required materiality to be included in the CFS, what is not required. What we do in the standalone financial statement preparation materiality, same materiality we have to do it in the now consolidated. So when we prepare the standalone financial statement, we always use the materiality. Now we have to use the materiality for the consolidated financial statement in a group as a whole. So here also we have to understand whether the items included in the consolidated financial statements are material or immaterial to be included. That is what the auditor's responsibility number one when it comes to SA 320. But the story didn't end here. Story to start here. The above computed materiality shall be used to assess the appropriateness of consolidated adjustment. Now tell me, who does the consolidation adjustments? Tell me, who does the consolidation adjustments? Sir, consolidation adjustments is the prime responsibility of the management. Management does the consolidation adjustment. Yes, sir, management does the consolidation adjustment. Now, when the management does the consolidation adjustment, whether they have done the consolidation adjustments properly or not, correctly or not, efficiently or not, the auditor will apply the group materiality on those consolidated adjustments. Now, read the sentence carefully. The above computed materiality. Now, stop. After that, read this point. Separate compute materiality for the group as a whole. Here we are applying the materiality for a group as a whole or not. So that materiality which we have applied for the group as a whole shall be used to assess appropriateness of consolidated adjustment. So we have to apply the above computed materiality for the group as a whole to understand whether the consolidated adjustments done by the parent management are appropriate or not, are correct or not, are good or not. Clear everybody? Yes sir, clear. Now the main points comes. These 2 points are highly important. These 2 points are highly important. Ab sunna dhyan se. Suppose Reliance is there. Reliance is having 90 subsidiaries. Let's take an example. Reliance is having 90 subsidiaries. There is one of the subsidiary which is not at all material subsidiary. It is very immaterial subsidiary. It is very what? Immaterial subsidiary. But the auditor of that immaterial subsidiary component has given any kind of modification or qualification. He has kept any kind of modification, qualification or reservation. Are you getting the one? He is having some negative aspects in his mind relating to that non-material subsidiary. Now in that case, whether the consolidated financial statement auditor also should ignore it to be included, or he should include it. Remember one thing, wherever in any component means what? Subsidiary, associate or joint venture, any kind of qualification, any kind of modification, any kind of reservation is being kept by component auditor. Qualification, modification and reservation is kept by the which component auditor? Component auditor means what? Either subsidiary auditor or joint venture auditor or an associate auditor. Then what is the responsibility? The responsibility of the consolidated financial auditor, he should not ignore that, even though it is immaterial subsidiary. He should not ignore that, especially in case of qualification, modification and reservation subsidiary, which is immaterial from the point of view of as a group as a whole. He has to include the same modifications, same reservations, same qualifications of the component auditor's report as it is in the consolidated financial statements audit report. Clear everyone? Even though it is immaterial subsidiary, but wherever the qualification, modification and reservation has been kept by the component auditor, the consolidated financial statement auditor should not ignore it. He has to include it as it is in his consolidated financial statement auditor's report. That is what I am trying to tell you. Now see, these 2 points are already over. This point is over. Key whatever we have to use the materiality, we have to use the materiality concept as a group as a whole, and we have to use that materiality as a group as a whole to assess the appropriateness of consolidated financial statements adjustment. Now, as being a component auditor, if they have already considered materiality in their own, in their modifications or reservation, if according to them as a component auditor, if according to them there is any qualification, modification or reservation in their component, even though it is immaterial subsidiary, now what is the auditor's responsibility? What is the CFS auditor responsibility? CFS auditor shall ensure to include the materiality considerations of component auditors on modification and reservations as it is in his consolidated financial statement audit report, irrespective of the fact whether he is a CFS auditor or the component auditors or not. Now let me give you a very simple example to understand. Mr. A is a CFS auditor, consolidated financial statement auditor. B, C, D, E are component auditor. This is material subsidiary, material subsidiary, material subsidiary. This is immaterial subsidiary. Now here, no modification, no reservation, no qualification. No modification, no reservation, no qualification. Here, yes, there are some modifications, reservations and qualifications kept by the component auditor called E relating to this material subsidiary. But what is this subsidiary? This is immaterial subsidiary. Here also, component auditor has kept some modifications, reservations and qualifications. Now, A is the CFS auditor. A thought that C will be included. Yes. D will be included, yes, because they both are material. Is modifications, qualification, reservations are also going to be included, but B is a very immaterial subsidiary. Its modifications, reservations, and qualifications are not required to be included. Then A is wrong. Even though it is immaterial subsidiary, if there are any modification, reservation, and qualifications in the immaterial subsidiary, still A has to include that in the his consolidated financial statements auditor's report. I hope now every one of you understood that it is not only the material subsidiaries information to be included, it is immaterial subsidiaries modifications, qualification, and reservation kept by the component auditor of that immaterial subsidiary is also required to be included as it is without any change. You are not supposed to include or exclude on your own. Your responsibility, your duty is to include it as it is. That is the reason I told you it is highly recommended question. Highly recommended question and very, very, very important question when it comes to the examination purpose. I hope everyone is crystal clear. Yes, sir. We are clear. So, relating to materiality, let's read it once again. Now, while doing the CFS audit, materiality shall be considered separately for all components. Yes, sir. But while doing the CFS audit, following other considerations. So, but that we also have to consider the materiality for a group as a whole, and the same above computed materiality shall be used to assess the appropriateness of consolidated adjustment. These points we already knew, but these 2 points are very interesting. As being the component auditor, they have already considered materiality on their own in their modifications and reservations. The CFS auditor shall have to ensure that he has to include the materiality consideration of the component auditor's modifications and reservations. What is this word used? As it is in the CFS audit report. Irrespective of the fact, either you are an auditor of the component also, or you are not an auditor of the component audit also. Correct, everyone? Yes, sir. This is what brings an end to the auditor's responsibility when it comes to standards. तो पहले हमने किया था auditor's objective. Quickly, just revise. What are the auditor's objectives? शुरू से करेंगे. What are the auditor's objectives? चलो वहां से रिवाइज करते हैं. What are the parents' responsibilities? Sir, total 7 parents' responsibilities. So, what are those? Primary responsibility of preparation of financial statement. Consolidated financial statement is a parent. Identification of the components and including the financial information in CFS. Then identification of the reportable segments. Identification of related party transaction, and obtaining the accurate and the complete financial information of its components, consolidation adjustments, conversion of gap, and harmonization of accounting policies. Clear, everyone? Yes. What are the auditor's responsibility? Point number A. What are the auditor's objective? To see that the consolidated financial statement must be prepared as per AFRF. Second one, to express an opinion on the consolidated financial statement. Next one, 143 subsection 1, duty to inquire has been performed. 143 subsection 3, reporting on certain matters have been performed. Clear? Then what are the auditor's responsibilities relating to standard? As say 300, he has to plan his audit in such a manner to ensure to complete his CFS audit on a timely basis, effective basis, and efficiently basis. So point number 2, he has to gain the proper understanding of the internal control system, accounting system, and the IT control system of an organization so that he can decide the NT of his audit procedure. Point number 3, he has to ensure his professional judgment to be used in understanding the risk assessment of the CFS audit and to plan his risk assessment procedures to reduce the risk to the lowest acceptable level. Point number next, whatever is applicable to the standalone financial statement, same AFRF is applicable to the CFS financial statement. What is the next? If the parent auditor is not the component auditor, then in that case he may consider to use the work performed by other auditor. But if he thinks that he can do the work on his own, SA 600 will not prevail. But if he thinks that he cannot do the work on his own, SA 600 will prevail. Then 580, the parent auditor's responsibility, consolidated financial statements auditor responsibility is to obtain the written representation letter from the management of the parent or from the TCWG of the parent declaring the 3 things. So what are the 3 things? CFS has been prepared as per AFRF. They take the 100% responsibility for the preparation of CFS, and they have considered all the material items while preparing the CFS audit. CFS statements, right? Next one, 320. Generally, we use the materiality concept for separate components, and therefore the same materiality concept we have to use it for the group as a whole, and the same computed materiality what we used as a group as a whole shall be used to assess the appropriateness of consolidated financial statements. Yes, sir. After that, as being a component auditor, if they already have given any kind of modification, qualification, or reservation of say for example of a immaterial subsidiary, then the CFS auditor is also having a responsibility to include the total modification, reservations and qualifications of that component auditor as it is, without changing, as it is in his consolidated financial statements auditor's report. Clear everyone? Done? I hope you are understanding what I'm trying to tell. So this is what do you mean by auditor's responsibility, and this is what do you mean by management's responsibility. So far everything relating to audit of consolidated financial statement you all understood. So let's take a break of 10 minutes, and after that we'll continue with the other topics. What is the next topic? We'll continue how to do the audit of consolidation, how to do the auditing of the consolidation. What are the things the auditor needs to do or needs to consider before doing the audit of consolidated financial statement? So auditor's responsibility over, management responsibility over, exemption part is over, division 1 division 2 is over, and 129.3 is over, 129.4 is over. So far we have done 50% of the chapter called Audit of Consolidated Financial Statement. So after the break, we'll start with the how to do the audit of consolidation. Clear everyone? Hello. See you after the break.